The World Gold Council saying that the demand for gold in the third quarter of the year was the highest on record and driven primarily by investment demand. Joe Cavatoni is the market strategist at the World Gold Council. Joe, good day. I do appreciate the time. Gold prices have been higher in the third quarter than ever before. We've talked before about the factors behind this. Is there a sense of FOMO as well? Is gold now at the point where people are buying it just because everybody else is buying it?
Well, Stephen, thanks for having me back. And I have to say that within the last 3 weeks, there's definitely been a lot of momentum pushing the gold price. The volatility levels are higher, and you could definitely give a little bit of that push well beyond 4,000 to a little bit of FOMO. But under all of it is a fundamental case for portfolio resilience and central bank functional shifting structurally their reserve requirements, and that's why gold is continuing to have very strong performance.
Gold is now at record highs, which means doing what the central banks are doing is suddenly a lot more expensive. And yet, I mean, are they still buying as much gold as they were despite these very high prices?
So it's a good question. The pace with which they've been buying has slowed a bit. They have healthy levels of consumption, but we're tracking at about three-quarters of what we've seen in previous years. So the third quarter has definitely seen a pickup. And the last 3 years, we've seen record flows of over 1,000 tons each year. And we're tracking at about 630 tons year to date. So we'll probably come in less than where we've seen it. But remember, this is a 16-year trend. And these levels are well above what we've seen over that 16 years. So they're still very active, and we see a lot more opportunity for the emerging market central banks to continue to bring gold into their reserve portfolio.
And a weakening dollar, I imagine, along with several other factors that are still present, and particularly geopolitics and everything else, it just means that that desire by central banks is likely to be present for quite some time, almost no matter how expensive gold gets.
I think that's right. I think what you're finding are central banks looking at, like you've said, geopolitical issues, trade tensions, questions around the US's ambitions or desires to reset the global trade environment, the strength and or weakness that comes along with the dollar-based asset performance. But don't also forget large markets like China and large markets in the emerging market sense are looking also at their homegrown challenges around their own inflation concerns and their own currency concerns. So there's definitely global implications that they could use gold and diversify into it, but also homegrown concerns that they're managing it with as well.
What's happening in jewelry? Obviously, gold for jewelry has, been a human tray for thousands of years. Is this sort of gold price having an impact on jewelry trends at all?
And that's absolutely the right way to think about it and what the data is telling us. This gold market for jewelry is definitely an emerging market, consumer market, China and India being the largest. And these higher prices making jewelry expensive makes it harder for people to obtain. So we're definitely seeing a slowdown. It's still very meaningful in terms of the above ground stocks as well as the actual levels of consumption, but you're seeing levels of 20 to 25% declines in the average level of gold consumed in jewelry in places like China and India. Higher prices, harder to obtain, slower for people to accumulate them. They may even be shifting away from gold to silver or something at a little bit more of a price point that's affordable.
I do wonder about that. And gold bars and coins, you say investment in gold bars and coins in the quarter was up 17%. A lot of demand there.
So again, at the heart of what we're seeing is this idea globally. Asia, the US, Europe in third quarter, all looking at portfolio resilience. So bars and coins, physical demand, as well as exchange traded funds, really driving a lot of what the consumption's looking like over the quarter. Record flows in ETFs, record flows in these other markets as well. This is really an interesting time, and it's actually all at the heart of it, looking at portfolio resilience.
I obviously never going to ask you what do you think the gold price will be, but we have seen some predictions that seemed like fantasy 2 years ago. The only thing I think it's safe to say is that unless something changes dramatically in the world, we're likely to see gold at sort of 4,000 for quite some time to come, despite the fact that a year ago that seemed incredible.
We were talking about it a year ago as something very aspirational, very exciting to see if it could get to that point. I think risk and uncertainty, the way the geopolitical landscape is playing out, it's going to keep demand well outpacing supply. Supply is only coming online at almost 3% per annum, and we're looking at double-digit growth in terms of the overall volumes of dollars being spent on gold and, 3, 5, 7% increases in the overall tonnage. So you're really looking at a pace that's going to keep that price supported. Again, we're going to see some volatility over the course of the next couple of months. We're coming into year end, some FOMO. People might be taking profits off the table, might be rebalancing, but the overall structural direction for gold remains very strong. Investment in central banks at the heart of that push.
Joe Cavatoni, thanks so much. Good to talk again. Market strategist at the World Gold Council.